These things give you a better idea where to set your strike prices. These things give you a better idea which expiration to choose. These things give you a better idea of how sound a stock price is. Is it overpriced? Is it underpriced? Have there been buyers below the market in the past? Have there been sellers above the market in the past? Are the options cheap or expensive? Which ones are more cheap or more expensive? So you use these things, and this makes everything better. And because of the effect of compounding over time, this is one of those little hinges that swing big doors.
Hello, Wealth Builders. You're listening to Wealth Building with Options. Here's your host, Dan Passarelli.
Hello, Wealth Building family. Welcome to episode 21, The Edge of Reason and the Reason for Edge. But before we jump in today, let's talk about how you can get the most out of the Wealth Building with Options community. First, consider sharing this podcast with like-minded people. Word of mouth is the best way to grow our community for all of us. And the more people you share ideas with and get frequency bounce back from, the more you grow as a trader. The second thing you can do is to support the show with a paid subscription. For the cost of one fancy Starbucks once a week, you'll get video extra podcast episodes and the option trade posts, where I drop into the deep end of the market, share trade rationales, and chronicle my covered call and cash cured put trades that I'm making in my real brokerage account. Plus, you'll get access to our monthly Ask Me Anything session and much more. To get all of this, go to my Substack at wealthbuildingwithoptions.substack.com. That's wealthbuildingwithoptions.substack.com, and subscribe to the monthly or annual subscription. Now let's tune in to higher frequency trading. I know a guy who is a card counter. I really kind of sound like a Chicagoan there. Hey, I got a guy. Right? I got a guy, but no, I do. I know a guy who's a card counter. I know a couple guys actually. And I was talking to one of them one time, and we were talking about just how much of an edge a card counter has. Let me define edge, by the way, before we go further into this. So edge, or an edge, is the measurable statistical advantage that one has. And you can see that in gambling. People commonly talk about the house edge, but for somebody who's a card counter, that's the edge that they have over the house. But we as traders and investors, we talk about this all the time too, and it's measurable in one way or another either way. So that's what we mean by edge, statistical advantage. Okay, so back to my story. So I asked him, well, what is the edge that you have over the house? And his answer was, well, it varies, and it varies based on the rules, because you go into one casino and they have to hit on soft 17, and you go to a different casino and they don't hit on soft 17, and you can't resplit aces on this casino, but you can on this one. So it really depends. It depends on kind of a lot of factors, which is really weird, but it does. But overall, he typically gets about a 1.2% edge. Now, the first time you hear a stat like that, you think, how the heck can this person live on a 1.2% edge? Because, there's people who make a living doing this and make a lot of money doing it, right? How can you live on a 1.2% edge? It's crazy talk, man. That's just plain old crazy, right? But really, it's not. that edge, that little 1.2% of your bet. So on like a $10 bet, that's what, 12 cents, right? 12 cents on a $10 bet. Oh my gosh. Or $100 bet, that's $1.20. But if you think about it, well, there's a couple factors here, really. I mean, first, what you have to realize is that the way that whole thing works is when it's more in your favor, you make bigger bets. And so that 1.2 on a bigger bet is, well, better. And the edge changes too. And so it's a higher edge. But nonetheless, let's just kind of keep it simple here. If you think about it, 1.2% on this hand, and then the next hand, and then the next hand, and then the next hand, you play hundreds of hands, thousands of hands, tens of thousands of hands, and man, that stuff adds up. Especially when you're doing this as a professional and you're really bankrolled, right? Well, look, this is exactly the same way it works with trading. I mean, just look at a typical option contract if you want to talk about, this idea of how do you make your money, volume, volume, volume. I mean, if you trade an option for 63 cents, that's 63 cents a share, and each contract's based on 100 shares, so that's actually $63. And if you trade 10 of them, that's $630. All of a sudden, you go from pennies to hundreds of dollars, right? So intuitively, even if a trader is making a couple cents edge on a trade, like even if it's like 3 cents edge on a trade, right? Well, 3 cents of option premium is $3 of money on a 10 lot. That's $30. That's $30 of like extra money, right? Think of what your results are now as a trader or as an investor, and think if you could add just a couple percent to it. Holy moly, that becomes super powerful. And especially if we're talking about as an investor. Because, as we've talked about on the show several episodes ago, this is really all about compounding. So you take what you're doing now, and all of a sudden you add a percent or 2 or 3 to it on all your trades, and see how that grows a small amount, which then grows a small amount on top of that over and above, and on all your new trades, it grows a small amount. Man, this stuff really, really, really snowballs. So, what I want to do on this show today is I want to talk about sources for edge as a wheel investor, because you have these sources of edge, and it's really, really super important to take advantage of all of them. So when it comes to really any sort of option trading, but we're keeping it in the context of wheel investing here, right? Covered calls, cash secured puts. But when it comes to any type of option trading, there's 3 analyses that are necessary to do: fundamental analysis, technical analysis, and volatility analysis. And with each of those, you can go as deep as you want into them. In a perfect world, you're a complete expert master of all 3 of those. But very few people are, even professionals. In fact, a lot of people who are really great fundamental analysts, they completely dismiss technical analysis. And a lot of the ones who are great technical analysts, they don't know anything about fundamental analysis. And unless you're really good with options, you might not know much about volatility analysis. Now, I will go as far as saying that as an investor, you want to know stuff about all 3 of these. The more, the better. But I'll tell you what, by the end of this episode, you're going to have a really pretty darn good toolkit on all of these. And I know that there's a lot of folks who are like market taker mentoring student traders who are listening to this, and you're already option traders. And so probably good with the technical analysis that we teach for the more hands-on option trading as opposed to investing. So I'll probably go a little bit deeper into the fundamental analysis part of this. And hey, full disclosure, and I say this about really everything that I do. I know as much as I know today about all the things that I know things about. Yeah, right. Now, what the hell does that mean, Dan? Uh, so a year ago, I knew less about this stuff. A year from now, I'm going to know more about this stuff. But over the many, many years of doing this, I've read books. I've had mentors. I've had mentors that have come in many different forms. Some professional traders from the trading floor that helped me master volatility analysis. I have had mentors in technical analysis throughout my days, teaching me the certain things that make sense for this and for that. I've had fundamental analysis mentors that have come in many sources too. My friend Russell, who is a professor at Indiana, I learned just some pretty simple things from him, just probably a thimbleful of his knowledge. Turns out my brother is really, really good with this stuff. Pick some stuff up from him. He's not even a professional trader. He's in a different industry, but he's really super smart with a lot of this stuff. So let's kind of dive in, go through each of these fundamental, technical, and volatility analysis, and get you started on getting more edge on all of your investment trades. Let's start with the fundamental analysis. So you can get as deep as you want to in this stuff. I mean, there can be a lot to it. And I don't go full bore into it. What the people who are really, really great with fundamental analysis do is they find the intrinsic value or a range for intrinsic value of a stock. And part of the reason why I don't go full bore into it is because I do a lot of analyses of different things and back testing and coming up with new models and that kind of thing. And frankly, it just takes a lot of time. I do a lot of research on every single thing that I trade, but I have to streamline my time. So I try to simplify it. And when you simplify it, you don't quite get to that level of saying, based on all this data that I input into this model, this is what my model says this stock is worth. That's great if you can do that and you have the time to do it and you have the knowledge to do it. And I'm going to give you some resources to get that knowledge in just a few minutes. But the things that I'm going to share with you today, they're shortcuts into that. One of them is the old tried and true, the PE ratio. Now, that is the price to earnings ratio. And there's different ways of looking at that as well. So first, what exactly is it? Well, the P price is the price of the stock that we're talking about. The price right now that it's trading in the market at this second, at this millisecond. Earnings it's one of two things. It can be the TTM, trailing 12 months earnings, or it could be the future estimation for earnings for the next 12 months based on analyst expectations. So the way I look at it is kind of the bird in the hand theory. Analysts can predict what the earnings are going to be in the future, but they're never going to be exactly right. They could overestimate, they could underestimate. And that could be, they're going to be off based on maybe their skill level. I mean, these guys make a lot of money, probably all somewhat skilled, I guess, right? But where they really end up being wrong is, well, something happened. Could be something like, oh, well, there was heavy storms in the month of June, and that shut down business and made things harder. Oh, there was this new health trend, and people don't eat as much of this anymore. They eat more of that anymore, and that affects sales, right? Could be anything that is unforeseen. So I like to use the trailing 12 months, TTM, thinking that that's somewhat indicative of future earnings. Now, this PE ratio, man, that's been around forever. This is what Benjamin Graham, who is thought of as the father of fundamental analysis, calls the golden ratio. And that brings me to a really good resource for you. In the show notes, there's going to be a reading list. And a really great book on this is called The Intelligent Investor by Benjamin Graham. Now, here's one of the crazy things, man. Sometimes things change over time. And hey, like I said, if you asked me last year, I'd have different thoughts on fundamental analysis. And if you ask me next year, I'll probably have different thoughts than I have right now. But there's some things that are really, really constant. And that book, The Intelligent Investor, was written in like 1949, I want to say, like the late 1940s, a long frickin' time ago, like 70 years ago. Now you might think, well, oh, geez, now we have tech stocks. Now we have SPACs. It doesn't matter. There are some things that are just fundamental baselines that never change. And then there's some things that change a little bit over time. Now, the PE ratio is still very, very relevant, but it's not quite as much in the spotlight as it was. I would think any good fundamental analyst would be looking at the PE ratio, but there's some other things that also come into play. One is the price to book ratio. Now, the price to book ratio is the price, stock price, to the book value. So, okay, what's the book value? And this is another thing that stems from Benjamin Graham's wisdom from the middle of the last century. Book value is all the assets that a company has after all the debt's paid off. Like basically, if you owned a company and you fired everybody, well, actually, hold that thought. But for now, let's say you fire everybody and you pay off all your debts, everything else you have left, that's your book value. That's what the company is worth on paper in the book, I guess, right? Now, there's a couple of things with that. Some of that book value might actually have to do with some of your employees. You got a really smart analyst or you got a really smart scientist, like, I don't know, that matters. That adds value to your company. That's more of a soft asset, I guess is the way that I think. Or intellectual property, right? Maybe you have a patent. How much is that patent worth? Well, it's kind of worth whatever I say it's worth. If I'm the CPA at the firm or the comptroller, whoever. What about things like, oh, goodwill? What the heck is goodwill? Well, goodwill is, look, we've been in this business for a while. We've got a good name. We've got a lot of intangible assets. That's what they call goodwill. And so there are some of these things that are really, really hard to measure, but they measure them anyway. And those are part of book value. So what some people will do is they'll look at what's called the price to tangible book ratio. That's getting rid of this patent that surely has value, but how much is the value? I don't know. How much is our brand name worth? I don't know. So they just get rid of that and they look at it, just the tangible stuff. All right. Then there is the operating earnings yield. So a company can get money from a lot of different sources. A company can maybe have investments. Maybe they've got some capital sitting around and they buy some T-bills or some blue chip stocks and they make money on it, dividends or interest or whatever. Okay. Or a company can issue new shares, sell equity and get money. Or they can issue debt and get money by borrowing it, right? But the operating earnings, that is the money that they get from running their business, from selling stuff that the company sells, running their business. So if we take all the earnings and just isolate it out to just operating earnings and see how much they make on those operating earnings, we can look at that yield percentage. And obviously, the higher that is, the better. And so that's the third thing that I think is important. And then fourth and finally is the current ratio. So in accounting, and I just realized this the other day. I totally forgot that in college for my bachelor's degree, I had a double major, finance and accounting. I totally forgot about that. I don't even think about accounting unless I'm looking at this kind of stuff. Ugh, I'll tell you. It seems to me like your brain is either wired to be good at finance or to be good at accounting. They're like two ways of looking at kind of the same thing, but gosh, they're just such different ways of thinking about stuff. Well, anyway, so the current ratio is the current assets divided by the current liabilities. And these are shorter term things. We're talking about inventory and we're talking about short term loans or whatever. So this gives you an idea of the company's liquidity. Like, is this company running their business in an efficient enough way where they're not going to wake up tomorrow and be like, oh, crap, we're out of money. We can't pay anybody, right? So the current ratio gives you an idea of the health in terms of liquidity of the business. So I gave you one book recommendation. And again, go and check out the notes for the episode down below. The Intelligent Investor by Benjamin Graham. Buffettology, written by Mary Buffett. And as I understand it, she had help from a friend of hers. I forget that guy's name, but she gets the credit for it. But that is apparently Warren Buffett's methodology for valuing stocks. Warren Buffett, by the way, was a student of Benjamin Graham's over in Omaha. So there's two. And the third one is How to Read a Financial Report, which was originally by John A. Tracy. And now the subsequent editions are by his son, Tage C. Tracy. I guess that's how you say that, Tage, T-A-G-E. So there are three books that if you read those, you're going to have a pretty good idea of fundamental analysis. Now, the next one here is technical analysis. Technical analysis, holy cow, there is a lot to it. Sometimes, like, you see somebody looking at a stock chart online, that's the graph of the stock price. You see them looking at a stock chart online, and there's like a million different lines of a billion different colors all going, and you don't even know what the heck they're looking at. And I'll tell you what, to tell you the truth, probably a lot of them don't even know what they're looking at too. I don't think you need to get that fancy. I've been doing this a long time. I've seen a billion stock charts. I'm sure that's an exaggeration, but it might be close. I don't know. Looked at a billion stock charts. And to me, the most important things are support and resistance. The absolute most basic thing you can look at. So let's back up for a minute here. While fundamental analysis is taking information that is fundamental to how the business operates. Technical analysis is, well, I'm going to throw a seemingly curveball here, but what it really is it's a map of human behavior. It's taking what happened technically in the past, like the stock traded at this price during this period, which is probably a day. It had a high of this price and a low of this price, and it opened at this price and it closed at this price. Let's take that data and put it on a chart with all the different periods behind it. Now let's look at how the graph flows. So that's technical analysis. Now, if a stock trades at a certain price, it's because one human bought it from a different human. And sure, they used the computer to actually execute it. And sure, probably at least one of them is running some financial model that tells them that they should buy it or sell it at this price. Maybe both of them are doing that. But it's still a human who programmed the computer and hit the button. And if a stock goes higher, why does a stock go higher? Well, because there's more buyers than sellers at that price. Like if a stock is offered at $99.58, well, there's a certain number of shares that are offered there. There's literally a human somewhere in the world who says, I'm going to sell 200 shares there. And you can look at, level 2 and stuff like that. And I mean, I don't know. I mean, I'm just looking at my Thinkorswim right now. And I mean, you can look at how many shares are offered, how many shares are bid. So if I see that there are 200 shares offered at $99.58 and I buy 200 shares, well, now there's not 200 shares offered there anymore. Now I bought all the ones at $99.58. If I want to buy more, well, somebody else is probably offered at $99.59. And I could buy the ones that are there. And if I want to buy more, I've got to buy the ones that are offered at $99.60. This is the mechanics of how buying pressure moves stock prices. It buys up all of the offers, or it sells all the bids and goes to the next one and goes to the next one. So when we're looking at these prices on a stock chart, it literally is a record of what humans did. It is a map of human behavior. When we combine that with volume, which is conviction, when there's greater volume, there's greater conviction. Well, it can give us a lot of information. Now let's get to those support and resistance lines that I was talking about. Support is a line that connects 2 points underneath the stock price. So basically it's when the stock gets down to a certain point, certain price, like maybe it gets down to $95, and then it went up after that. And then maybe later, 3 days later, 3 weeks later, 3 months later, it goes back down to $95 and bounces back up again. And maybe it does that a third time, back down to $95 and bounces up again. Why would it do that? Well, it's not just some random thing. It's, again, a map of human behavior. It's very clear that there was somebody who has a lot of bids there, who's probably is running a financial model, one of those probably fundamental models that I was talking about, intrinsic value, where they say, hey, this thing is worth 105 or something like that. At $95, we're far enough below it to have enough of a cushion that we should buy a lot of it because it's very, very inexpensive relative to where we believe it intrinsically is worth. And how do I know this? Because it couldn't be anything else. If it goes down to 95 and they can't sell enough bids to push it down farther and it goes back up, that's because there's a lot of bids there. There's a lot of buying pressure there. And if it does that a couple of times, 2 times, 3 times, 4 times, 5 times, especially on high volume, well, that means that there has been some bids there. And is that likely to change in the future? Yeah, maybe. It depends. If new earnings comes out or new information comes out or they run their models again and their intrinsic value is something different, well, maybe they'll pay more. Maybe the stock will have a hard time falling below 100 next time. Or maybe they'll pay less and the stock will easily go through 95 but can't get through 90. This is support. Okay? This is where the buy orders have been in the past. If a stock got down to a price and bounced up above it, that's the only rationale for what could possibly be happening. There's a lot of buy orders at that price. Resistance. That's just the opposite. That's where the sell orders have been. That's when a stock gets up to a certain price and can't buy up any more of those offers that are there. And so the stock goes back down, and then maybe it goes and makes another run for it, but can't get through that price. Maybe it's $105. Hits 105 and just can't get through it, can't take out more of those offers because there's too many shares offered there. And it goes back down, and maybe it does it again. The more times it hits that, the stronger the conviction. The higher the volume, the stronger the conviction. That is resistance. That is where the sell orders have been. So there are all these other things that can go on a stock chart that are super fancy, and they all have their uses. Just because something's fancy doesn't mean it's not useful at all. I'm sure there are some things that maybe aren't useful at all. I can't think of what they are either way. But I think that support and resistance is some of the most useful stuff that you can see on a stock chart that you can use because it gives us so much real information. And that information is really important. And we don't know for sure that that's where the buy orders will be in the future or where the sell orders will be in the future, but it's proven that that's where they were. It gives us one piece of information that we take with less than a grain of salt. I always wondered, is it more than a grain of salt or less than a grain of salt? So I ended up looking it up. You know where that comes from? It was like a Roman thing, like one of those Roman guys that we've heard of. I forgot who it was, but had certain medicine that didn't taste very good. So you'd have to take it with a grain of salt. So kind of the worse it is, or, the less you want it, the more salt you would have to take. So if it's friendlier, more conducive, you take less salt. So anyway, but there are some of these things that I do use and that I do look at. I do look at moving averages, and there's a reason for that. One of the moving averages that I look at is the 200-day moving average. And I was told once by someone in the industry, and confirmed even more recently, that there are some professional traders out there who it's in their charter that you're not allowed to own a stock that's below the 200-day moving average. And hey, let's face it, if you put in your prospectus at the end of the year, hey, we own this stock and it's below the 200-day moving average, your investors are going to look at it and say, why the heck did they own this stock? It's below the 200-day moving average. So when a stock falls below the 200-day moving average, it tends to keep going a lot of the time. And if it rises above the 200-day moving average, it tends to keep going and stay above it. And in fact, that 200-day moving average can act as a support line or a resistance line. Now, one thing about support and resistance lines, whether it's the moving average or just a horizontal line that you can draw to connect to prices below or above the stock, is that once they're permeated, once the stock goes through, say, support, falls below it, support can become resistance. And when it goes above resistance, that resistance can now become support. Now, another thing is moving average crossovers. The 21-day moving average is another thing to look at. When a stock goes through the 21-day moving average, it tends to have some follow through, usually just for a short period of time, for my observation. But let's back up again and think about this. Why do we really even care about some of this stuff? Why do we care if there's support or resistance? Why do we care if it's above or below the 200-day moving average? Well, because if we're trading covered calls or cash secured puts, that can give us really good information. Let's look at the cash secured put with the Skates objective again. So let's imagine an investor who is looking at a stock chart. Maybe he or she has done some fundamental analysis, or maybe they're strictly technical. Looks at it and says, wow, there is a lot of support at the $400 level. It's bounced off it 5 times over the last 2 years, and it's just headed higher ever since. Oh, and the 200-day moving average is just below that at 390. There's even more support there. Geez, I think this stock is going to have a hard time going below 400, and if it does, harder time still going below 390. What information does that give us if we are a cash secured put trader? Well, what if we sold a cash secured put at or below $390? Maybe $385 to get a little extra wiggle room, maybe $380. Well, if there is this thing, which in the case of regular horizontal support, buy orders, or the 200-day moving average that we just know acts as support often, this little extra edge that makes it more statistically likely than just some random distribution would tell us of staying above those levels. Now, it's not guaranteed. Nothing's ever guaranteed. But if we think about stocks as like a log normal distribution with leptokurtotic tails, is how technically it's thought of, there's something that would throw off that log normal distribution. There's a little bit less of a chance of it going below that price because of the support, horizontal or 200-day moving average. So these things end up becoming very, very valuable little bits of information. All right. Now, the third edge source is volatility analysis. Now, this one is very options centric. I mean, we can look at historical volatility just for the stock price. We can, but we can't look at implied volatility because that is the volatility that's implied by option prices. Historical volatility, and I know we talked about this before, but you know what? For me, when I'm learning something, I not only don't mind a little repetition, I love a little repetition. It just reinforces things. Even if I already know it pretty well, sometimes somebody will say something that like makes me think about it in a little bit of a better, smarter way. So if this is review, keep listening. I promise you, you're going to be happy you did. And if it's brand new, listen really, really hard. This is important stuff. Historical volatility is they take the closing prices of a stock, usually from the last month, and they find the standard deviation, and then they annualize it to make that 1 month representative of a 1 year period. Okay. That's pretty simple, straightforward. If any of these terms are new to you, like Google standard deviation, oh gosh, you're going to get so much more than you bargained for, but just read the highlights. In fact, even if you're not really a mathematical person and you don't want to go down a rabbit hole, don't Google it. Just know that there's this thing called historical volatility, and it's a number. The bigger it is, the more volatile. The smaller it is, the less volatile. That's really all you got to know. Implied volatility is basically how cheap or expensive the option is, because options are tricky, right? If the stock goes up, calls get more expensive, puts get cheaper. If the stock goes down, it's the opposite. As time passes, both of them lose their value. As the interest rate changes, that affects each of them. The dividend changes, that affects each of them. So there's a lot of moving parts. But another thing that affects them is just that plain old supply and demand, like I talked about for a stock. There's bids and offers for options as well. And when somebody buys all the offers, the price goes up, supply and demand. Well, that's what implied volatility measures. Now, people tell you that it's the market's estimation for future volatility. That's almost kind of right. There's some truth embedded in that statement, but a lot of people don't do an analysis and say, well, this is what future volatility will be, so I better buy these options. It's not how a typical trader trades. It's certainly not how almost any retail traders trade. And that's not how most professional traders trade. So there's a lot of noise in that assumption that it's the market's estimation of future volatility. There's a lot of things that just make it not true. So what it really is it's how cheap or expensive the option is. Now, okay, let's kind of go full circle here for a second. It should be the market's estimation for future volatility. Because if a stock ends up being massively volatile in the future, it's historical volatility, like 100, but right now the option is trading with a 20 implied volatility. Goodness gracious, if you buy that option, you're going to have such a humongous advantage because you're buying it arguably priced below where it should be. Priced as in all those other factors held constant. The direction, the time, the interest, the dividends. Hold all those constant and just look at how depressed the price is from oversupply, selling, or how rich the price is from over demand, buying, and you can get a real edge there. Now, here's where it gets a little more heady. If you're looking at an option chain on any individual stock or ETF, all the options have a different implied volatility. Like you can put a column called implied volatility in there that shows you the implied volatility of each option. They're all different, but there's a pattern to them. The vertical skew measures the relationship of the implied volatilities of all the options within a certain expiration by their strike. And it's vertical because, it's listed up and down, I guess. What typically happens is the lower the strike price, the higher the implied volatility, and the higher the strike price, the lower the implied volatility. That's your vertical skew. Now, why does that matter? Well, because there's a lot of decisions that go into which strike price to trade. There's exit point if it's a covered call. I would sell the stock if it gets up to 300. So maybe I'll set my call strike there. But if I can sell a somewhat higher implied volatility by selling a lower strike, if I'm between deciding should it be the 290 strike or the 300 strike, if the 290 strike has a higher implied volatility, it gives me a little tiny extra edge, oomph, selling that higher implied volatility. And then there's term structure, which is the observation that volatilities of options with the same strike price, but just with different expirations, can be different. That's the term structure. So it's like the June 200 calls versus the July 200 calls versus the August 200 calls. Or, for things that have weeklies, which is most things these days, maybe that's the August 1st 200 calls versus the August 15th 200 calls versus the August 29th 200 calls. Those are going to have different volatilities as well, each of those options. That's the term structure, the horizontal volatility, or the time skew is another way to think about it. Well, why does that matter? Well, because another choice I have is which expiration to sell the option in. Well, I could sell the 14-day one or the 21-day one. Maybe the 7-day one or the 28-day one is a choice as well. Well, there's a lot of factors that go into that too. But one of them can be and should be which has a higher implied volatility. Now, that's not the be all end all. That's not the deciding factor, but that is one of the factors. The one that has the higher implied volatility based on that factor is a higher candidate, a better candidate. So these are your main sources of edge when it comes to trading covered calls and cash secured puts. These things give you a better idea where to set your strike prices. These things give you a better idea which expiration to choose. These things give you a better idea of how sound a stock price is. Is it overpriced? Is it underpriced? Have there been buyers below the market in the past? Have there been sellers above the market in the past? Are the options cheap or expensive? Which ones are more cheap or more expensive? So you use these things, and this makes everything better. And because of the effect of compounding over time, this is one of those little hinges that swing big doors. And that about wraps it up for this show. But before you go, please help grow the Wealth Building with Options community by subscribing to it in your favorite podcast app. When you do, you'll be the first to hear episode 22, which is going to be specifically on buy rights. And that is going to be an episode you don't want to miss. See you then. And in the meantime, invest excellently.
Options involve risk and are not suitable for all investors. Before buying or selling an option, read characteristics and risks of standardized options. A link is provided in the show notes. To learn more about your host, Dan Passarelli, please visit markettaker.com.